Everything I just described is playing out, and there's data to back it up, not just an inverted treasury yield curve, which is interesting. Well, 2 is the main sector where it's inverted, but even more profoundly in the Eurodollar futures curve. Yeah, I call the treasury yield curve a short-term bet on a long-term rate. The Eurodollar futures curve is a long-term bet on a short-term rate, because the Eurodollar future it's like we're betting on what an overnight rate is going to be 2 years from now. So, okay, long-term bet on a short-term rate, and it's inverted, and it shouldn't be inverted. That should never, it does happen, but it should not happen. Yield curve should be upward sloping just because time value of money and uncertainty, et cetera. If I lend to you for a longer period of time or make a further forward bet, I should get a higher rate. Well, how come people betting on overnight rates a year or 2 years from now think that rates are going to be lower? And that shouldn't happen. The only explanation for that is we're going to go into recession. It's going to get a lot worse. But going back to a really important distinction between a recession, even a bad one, and a financial crisis, because they're two different things. They can come together. But for example, in 1998, we had an acute financial crisis, and with long-term capital management, and I negotiated that bailout. I had front row seat on that one. But 1994, the tequila crisis, and there was the bond market massacre. There have been these financial crises, but there was no recession in 1998. In fact, the NASDAQ went to the moon. We were looking, long-term capital, we were licking our wounds after the meltdown, and turning on CNBC and like watching pets.com, the sock puppet, and all these things. They're going to the moon. Like, hey, we just got wiped out. But the opposite is true. You can have a recession without a financial panic. 1990, we had kind of a mild recession. There was no financial panic then. 2020 was interesting. I don't know what to call it. I mean, technically a recession, but the economy drops 31% annualized. And they say 2 quarters, first and second quarter of 2020, but it was really 2 months. I mean, if you break it down, it was March and April. They happened to fall in 2 quarters and took both quarters negative, but it was really 2 months, down 31% in annualized in 2 months, and then up 35% by the third quarter. I mean, that was crazy. So maybe that's technically a recession. That's just what happens when you shut down the economy. But there was not a financial panic. Stock market fell, but the banks didn't fail. Nobody's lined up to take the money out of Citibank, et cetera. So you can have recessions without panics. You can have panics without recessions. October 19th, 1987, Dow falls 22% in one day. No recession. But sometimes they do go together. In 2008, they did. We had both. We had an honest to goodness financial panic. Everyone knows, Bear Stearns, Fannie Mae, Freddie Mac, Lehman, AIG. But I can tell you, and I've spoken to a lot of people, Morgan Stanley was days away. And then Goldman would have been behind that, probably Citi, and maybe JP Morgan would have been the last one. And the economy collapsed and the stock market fell well over 50%, I think 60%. So that was an example of both. And what I'm concerned about is we may be heading into both. For everything I said about what's behind the curtain, the plumbing of the financial system, acute dollar shortage, scramble for collateral, which leads to deleveraging, because if I can't get the collateral, I got to take the trade-off. Leveraging of balance sheets, et cetera, which are the early warning signs of a global financial panic. And a likely recession. We could very well be looking at a severe recession and a global liquidity crisis, 2 different things, but they could converge. Got to give a little credit to Robert Shiller. He wrote a great book called Narrative Economics. Now, narrative is just a fancy word for a story. It's like, okay, you can call it a narrative, and it means a lot of people buy into it, but it just means there's a story that people believe. And this goes back to the greatest sociologist of the 20th century, Robert K. Merton. There is no Nobel Prize in sociology, but if there were, Robert K. Merton would have won it. But he's the one who came up with the phrase, the self-fulfilling prophecy. And the classic case is you wake up in the morning, the bank's fine, but somebody gets nervous and they run down and take all their money out. And somebody sees them and go, what are you doing? So I'm getting my money out of this bank. Okay, I better get my money out too. And everyone's like, I don't want to be the last one out. Next thing you know, there's a line around the block. And by the end of the day, the bank shuts its doors and they're bankrupt. But they weren't bankrupt at 9 o'clock in the morning. It's because a story spread. People believed it. People acted on it. And that's the key. Do you act on the story? You can make the thing you're worried about come true, even though it wasn't true when the story started. Narratives can be true, but they can be false. In other words, a completely false narrative can be extremely powerful if enough people buy into it. The Fed pivot is a narrative, and it went like this. So inflation takes everyone by surprise in fall, late 2021. November 2021, Jay Powell says, time to retire the word transitory. And then inflation goes to the roof. The stock market goes down. It's still going down. But then after the Fed raised rates, and then the yield curve is inverted, the narrative is like, well, wait a second. The yield curve inversion is telling us that rates are going to be lower months from now. Inflation's cooling off a little bit, and it has. And so they're going to have to cut rates. That was the pivot. And rate cuts are good for stocks, so buy stocks. But then we get this rally, and the stock market's, recovering a lot of this, not all the lost ground, by the way, but a lot of it, all based on the Fed pivot narrative, which I never bought into. I mean, you don't want to stand in front of a moving train. I wasn't going to short the S&P. I did not buy into the narrative. I said for two reasons. Number one, inflation came down from 9. Well, that's nice, but you say you want to get it to 2. You're a long way from 2. And how much demand destruction, how many rate hikes, how much do you have to do to really destroy the economy to get inflation down to 2? The answer is a lot. And tell me why that's good for stocks. And it's not. But the other reason is, and this is a little more sophisticated analytically, but just because the yield curves are telling you that market pros think rates are going to be lower, it doesn't mean the Fed's going to cut. That is the message, but it doesn't mean the Fed's going to get the message. How many times does the Fed get things right? The answer is never. The buy the dips crowd have not gone away. They're still around. I'll say talking heads, I guess I'm one, but the cheerleaders, I'll put it that way. The Wall Street cheerleaders have never gone away. The Wall Street always wants to sell you something. The people who think the Fed knows what they're doing, there's some of those. But the fundamentals have not changed. Forecasting the consequences of Fed policy is really difficult, but forecasting Fed policy is the easiest thing in the world because they tell you what they're going to do. But the hard part is what's going to happen as a result of that. And the Fed's thinking maybe hard landing, but not too bumpy. And I'm thinking more like a plane crash. Not to get too geeky, but sometimes I can't help myself. There's a concept, it's not that difficult. It's called DV01, which is the dollar value of 1 basis point. And what it means is if interest rates go up, 25 basis points, what's the change in the price of securities? In other words, what's the rates up, prices down, rates down, prices up. That's just bond math, but it's not uniform or linear at all levels of rates. So when at higher rates, the DV01 is lower, and at lower rates, the DV01 is higher, which means the impact of every basis point increase in interest rates is greater at lower levels, right? So in other words, raising rates from, I'll just say 2 to 4 for a range is much more damaging to prices than going from 8 to 10. Much higher interest rates, a whole different world. But the impact of that on bond prices is less than going from 2 to 4, where it's like you're just putting these bonds in the cellar. And that plays out in derivatives world. So that's another factor, along with scarcity of collateral, shortage of dollars, quadrillion dollars in notional, deleveraging balance sheets, and a higher DV01, meaning these interest rate hikes do more damage per basis point to bond prices than if they were at a higher level. That's definitely cause for concern.